So we get questions. This is another one of our client questions, which we get quite frequently. And it's just whether or not you should use leveraged ETFs in really any capacity, whether it's a broad-based ETF that's leveraged or if it's a specific stock. And I'm really just going to go through a high level of these products, how they're structured, and whether or not you should even consider using them at all. So leveraged ETFs come in various forms but function in similar manners. They will target a multiple of an asset return or a benchmark asset, whether a stock, an index, or even another ETF. It can be anything in reality for a set period of time. The multiple range normally from 3 times. So you're bullish, you'll return 3 times a stock, or at least that's what they target, down to negative 3 times. So that's a bearish ETF or an inverse ETF. So for example, a 2x leverage ETF, if the underlying asset returns 25%, the leverage ETF will return 50% if their target remains true for that time period. And if it were a negative 2x ETF or inverse 2x leverage ETF, it would return negative 50% on a 25% asset or benchmark return. The managers of these funds generally use swaps to achieve this effect. It's a type of derivative to achieve this, but you don't really need to worry about that. You can really just picture in your head, like margin, it does have some technical differences, but just for a high level, you can think of it in the same sense, taking a loan to buy more shares. So the time period for these is a very significant factor, and it's because it's how often these ETFs or funds reset its leverage to its stated leverage. So whether it's 3 times, 2 times, 1.5, whatever it may be. And at this time, most ETFs and funds generally reset once a day, but there are some that are monthly and some that are weekly. This factor is extremely important as the leverage will drift away from its targeted leverage during its intra-period. But the more frequent reset period, the higher the volatility decay. Volatility decay, or sometimes called beta slippage, is simply the loss of value due to the rebalancing to a set leverage. If you allow leverage to move more freely and you are long, if the asset drops, your leverage increases, and vice versa. If the asset decreases, that's your free-floating leverage, like if you're on a margin account. But these, they reset their leverage, whatever they say, most likely daily. So a simple example with high volatility is if you use a 2x long position on a stock and it drops 25%, you've lost 50%, and your leverage would now at that time, if it was free floating, would be 3 times, assuming the position is still intact, no margin call or anything like that. So if the benchmark were then to rise 33%, returning to that initial value, the stock or asset, whatever it may be, would be 0% return over those 2 periods. However, if you have a fixed leverage with it resetting every period, this will not occur. If we do the same drop of 25%, then increase 30%, 33% of the benchmark asset, the 2x leverage ETFs that resets will actually have a negative return of 16.7%. And if you were to extend this exact same pattern of going up and down the same amount over and over, resetting to 0% asset return over and over again, the more periods you have, the more decay will occur. So really what I mean, but what I want to show with this is if you have more frequent resets and it is just doing this volatility up and down, then you'll actually get a worse return. You'll underperform even if you have leverage, even if no direction changed. And that's the point I want to get across with this slide, because we're going to go a bit more complex and why these don't always work in the long term. So here is a table for a 3x leverage fund expected performance given the volatility. This is before fees or anything like that. It is a lot of numbers, but the point I want to get away here is the dark gray, given a certain volatility and then a certain return, is where the fund will actually underperform its targeted return over multiple periods. And the light gray is actually where it will overperform the targeted rate over multiple periods. So a key takeaway of this is really the higher the stock price volatility or asset volatility, the worse the leverage funds will perform, even if you are directionally correct if you buy a long leverage ETF and the benchmark asset appreciates. If the volatility is high enough in this asset, you will actually underperform the non-leveraged benchmark. On the other hand, if there's no volatility or little volatility, the leverage fund can actually outperform its own targeted return of its targeted daily return once you're compounding for multiple periods. So if, for example, on this table here, if you had a 0% index volatility and we go right to the bottom left corner there, the target return would have been 180% if you just had 3 times return, but it's actually 310% return. And then if we look at the bottom right, same thing, the expected 180% return if it was a true 3 times return, but at 60% volatility, now we only have a 39% return. So very significant difference, to say the least. Now, shifting to a real-world example, MicroStrategy, as it is very volatile, and Brennan recently took a position on it as he made public a couple months ago, and he has since closed it, though. I'll let him talk about that after. So this chart up has both the long and short 2 times ETFs, MSTU for the 2x long and then MSTZ for the 2x short. Since November 13th, the stock has returned it's returned negative 3%, so it's lost 3%, effectively flat as far as MicroStrategy goes. But both the 2x long and the 2x short ETFs have actually both had negative returns of losing 32% and 49% respectively for the long and short ETFs respectively. This is the volatility decay, as the underlying MicroStrategy shares have been extremely volatile during this period. So even if the stock has not really moved, you can still lose money with these ETFs. That's what volatility decay does. However, if we zoom out, both these ETFs, they started trading on September 18th. MicroStrategy's shares returned has been 142%. The 2x long has returned 243%. So not quite that 2x return, but it's at least still positive. Whereas the 2x short has returned negative 96%. You have 1/25 of your portfolio remaining if you use this ETF. And you'll see this with a lot of these long and short ETFs, is they'll have long-term returns that are very, very, very negative and nearly 100% in many cases. So, but however, if you look at the peak of when MicroStrategy shares were trading at its local peak during November 20th of $474 a share, it had a return of 257%. And since the ETF started trading, the 2x long actually had a return of 906%, well over that 2x daily target, as well as it well exceeded the volatility decay, the compounding return of having 3x daily. So the point of this is really to show how much your holding period matters when it comes to these financial instruments, and why daily leverage ETFs should generally and very exclusively not be used for long-term holdings, as the return will deviate significant from expected return. You will not get a 3x return if you're holding these for more than a day. It's just not going to happen unless it's just by pure chance. These are made for traders. They are not made for long-term holdings. Even if certain time periods you will outperform, you might even have higher return than their stated daily values, but it's very unlikely to hold in the long term due to the decay. You can view yourself as being short volatility when buying a leveraged ETF, as the increase in volatility will negatively impact you, or realized volatility, I should say. A combination of higher leverage, more frequent leverage reset periods, and higher volatility, the worse the leveraged ETFs or funds will perform, regardless of the direction of the movement of the benchmark. You can be correct in the direction, but if you are using this instrument, if the volatility is too high, you can still lose money. Overall, these instruments are really designed for trading, not for long-term holding over multiple leverage reset periods. So if you have a buy and hold mentality like Keystone does, they just aren't worth using.
Yeah, good job, Brett. So yeah, I always need to preface it, but because I will go into, just to show my real world example and what the return would be, or what my return was versus what the return would be if I continued to hold it today. So again, need to preface it. Was completely speculating on this, trade, or in other words, gambling. And I was gambling on MicroStrategy here. So I was using the 2 times inverse MicroStrategy ETF, or ticker MSTZ, to essentially short MicroStrategy. So try to follow along with me and keep these numbers in your head. So MicroStrategy was trading at about $380 per share when I initially entered the position, and I closed my MicroStrategy short on the MSTZ on December 19th, when it traded at about $326. That was MicroStrategy. And I closed out my position for about a 19% gain. Now, if I continued to hold that position today, despite MicroStrategy trading at $328 today, which is essentially the exact same price I closed it out for on December 19th, today, rather than a 19% gain, I would actually be down 10% on that position, just because I've continued to hold it, even though, MicroStrategy's stock price is at the exact same spot. So again, this just shows the volatility decay, which Brett went over. Again, these are for traders, not long term.
So over what period of time was that?
So I entered it November 30th and closed it out December 19th. So I'm not sure how many trading days that would be.
So in less than 2 months, even though the share price was actually at the same price, it was lower. So you bet on it right. You bet on it right. It was higher, went lower. You would have lost around 10 or 11%, essentially.
Yeah.
So that just shows you, even if you're right, you can be wrong in terms of your pocketbook.
And what if the share price had gone up and you continued to hold it?
Well, then I'd be down even.
So in the three scenarios, there's only one that you make money. Like it can either go down, it can go up,
exactly.
Or it can stay flat. And 2 out of 3, it sounds more like a trip to Vegas, and
exactly.
That's more fun, at least for me. So
it's just, Brett did a good job in showing the decay and how that affects your returns, particularly the longer you're holding that investment.
I think it's great that this is being discussed, because we talk about ETFs sometimes and as being, good ways to get low cost, easy exposure to, a wide range, to an entire market. But specifically, we're talking about indexed ETFs, indexed mutual funds that just basically buy the stocks in a market in proportion so that they track the market. But ETFs can also, as Brett showed, come in very different forms and very high risk forms. And we always say, if you're looking at an ETF, great if it's a simple vanilla ETF, no derivatives, no leverage, nothing that you cannot understand. If you start scratching your head when it's being explained how it works, that's a problem, and just dismiss it. It's not an investment.
Yeah, if you don't understand the name of it, just X out. Don't touch it. It's just simple. Because there's ones that are much more complicated than this even. And I will see those floated on online boards at times as a good investment when they just have no understanding of what's going on time and time again.
I feel like investors too, or speculators, gravitate towards these, 2 times, 3 times ETFs because it's like quick gains or quick money, but like it's not the case. Like, again, even just like people that are enticed by options, again, not a great place to be.
Quick gains, quick losses, long losses too. Losses, as we see with the volatility decay, can really become a long game of losses.
Yeah, it's just hard to fight against that volatility and the time, again. Yeah.